Hi, I'm Kerry Craig, Global Market Strategist. In this video, I'll be outlining our key themes from our first quarter 2023 guide to the markets. 2023 is unlikely to be a great year for the economy, but a better one for markets. The impact from higher interest rates will have a lagging impact on the economy and bite harder this year than they did last year. But markets are unlikely to suffer a second year of large declines. The weaker growth outlook is tempered by the fact that few economies are showing any signs of a significant imbalance that would lead to a deeper recession. So we expect any recession in the US or Europe to be relatively mild compared to history. Meanwhile, there are few signs that Australia is heading for anything other than a soft patch of growth. China is also rejoining the world economy as COVID restrictions are quickly loosened and policy remains supportive of growth. This should have a positive impact on the Asian region as pent-up demand is released. When it comes to investing, the market is not the economy in many ways, and assets are much more attractively priced starting this year than they were this time last year. This creates a potential for better returns in 2023, even with the near-term uncertainty. And in the near term, we do remain cautious on risk assets, given the still elevated levels of core inflation in developed markets and the contrast between market pricing of where policy rates may go and central banks' commitment to drive inflation back to target at a time when economic growth is deteriorating. The risk of a policy error may have diminished, but it has not disappeared. This means a focus on quality in both equity and fixed income markets. Equity markets may not go back to last year's lows, but history suggests that markets bottom during a recession rather than ahead of it. Our preference is for more defensive sectors within developed market equities and a diversified global focus rather than a country-specific one. Emerging markets are looking attractive given the shift in China and a fading headwind from the US dollar. Bonds are also relatively attractive, and we do not expect a repeat of 2022 given higher yields, lower inflation, and central banks being closer to the end of rate hiking cycles than the start. Short duration is more appealing at this point given the chunkier yields and the near-term risk of a repricing of expectations for policy rates. But overall, investors are pivoting back towards bonds in search of both income and diversification. Thanks for watching.